We are living through a period of record-breaking corporate earnings, even as the physical ecosystems that sustain human life face structural collapse. This gap between wealth and reality is most visible in heavy industry and finance. On trading floors, prosperity is an abstraction, measured by stock valuations and quarterly dividends. Behind those numbers, the material reality is far different. Thousands of acres are stripped, ecosystems are drained, and centuries of biological growth are leveled to fuel the industrial machine. Accounting systems mathematically protect this destruction, ensuring it remains invisible on the corporate balance sheet. These ledgers effectively treat the liquidation of planetary resources as a financial gain rather than a permanent loss of capital. To understand how books are balanced, we have to look at the concept of capital maintenance. This is the accounting threshold that determines whether a company has earned a profit or is simply consuming its own assets. Historically, economists like John Hicks argued that true income only exists after a company sets aside the resources needed to maintain its physical productive capacity. You have to keep the foundation intact before you can count your earnings. Modern standard-setting bodies like the FASB and IASB moved away from this physical requirement, favoring models that prioritize nominal monetary returns for shareholders. This shift institutionalized financial capital maintenance. In this model, success is defined exclusively by an increase in monetary net assets. Because the focus is strictly monetary, the funds required to replace physical machinery or remediate environmental damage are entirely excluded from the profit calculation. Corporate books now operate in a dimension divorced from physical reality, where the decay of the material world never appears as a liability. If we forced the world's largest industries to audit their unpriced ecological liabilities, what would happen to their reported profits? The United Nations Environment Program commissioned a forensic audit to answer that question, measuring hidden costs across 500 global business sectors. This data reveals a staggering unpriced subsidy of $7.3 trillion, equivalent to 13% of global economic output consumed in a single year. Consider South American cattle ranching, which reported $16.6 billion in gross revenue. To achieve that revenue, the industry consumed $353.8 billion in unpriced natural capital through deforestation. That represents an environmental deficit equal to 1,800% of its revenue. Global cement manufacturing provides another example, reporting an average positive margin of 7%. Once the costs of carbon emissions and particulate pollution are factored in, that profit evaporates into a 67% pre-tax loss. When full physical capital maintenance is applied, none of the world's top industrial sectors remain profitable. They are liquidating the planet's assets at a massive net loss. Why do the ledgers of global industry systematically omit these liabilities? Karl Marx identified this as a structural necessity of the capitalist mode of production. This formula illustrates the pressure. Profitability, R, depends on maximizing surplus value, S, while suppressing the costs of constant and variable capital in the denominator. To prevent the rate of profit from falling, capital must aggressively minimize these costs. Treating the biosphere as an unpriced free gift keeps constant capital costs suppressed. The environment becomes an unpriced repository for waste. Forcing capital to pay for its true physical maintenance would expand the denominator and eliminate surplus value, effectively stopping the profit engine. Marx described the physical consequence of this accounting as a metabolic rift. Industry must continually exploit its exploitation of nature to outrun its naturally falling profit rate. By destabilizing ecosystems to preserve the ledger, capital undermines the material foundations required for its own long-term survival. These unmaintained physical costs are simply offloaded onto the public and future generations as systemic climate and ecological crises. This outcome reflects the internal logic of the ledger itself, a system performing exactly as its rules demand. The appearance of genuine net wealth rests on the liquidation of the Earth's balance sheet, recorded in the books as quarterly income.